Good afternoon, real estate professionals. Welcome. Thanks for being a part of our Agent Advantage webinar this afternoon. My name is Kurt Klaus, and today our webinar topic for you, the real estate agents, is Unlock Your Purchasing Power with Reverse Mortgages. So I know we are all familiar with reverse mortgage, but this webinar will help you, the agent, understand more about reverse home equity conversion mortgages and how they can really benefit you, the real estate agent, to help your buyers finance a purchase. We want to debunk some of the myths. It's really surprising to me to know how many people in the industry don't totally understand the benefit and the value of this product. And you, the agent, this is something that can really, it's a really great way to increase the buying power, and it's a great option for your buyers if, of course, they meet the age requirement. So plan on 45 minutes or so, take some notes, ask questions. We have these live webinars. I see lots on the call. People are still jumping on, but we'll save a few minutes at the end to answer your questions. But these webinars, first off, are brought to you by the Agent Advantage website. If you're unfamiliar with Agent Advantage, it is our no-cost website for all of our agent referral partners. Agent Advantage is a shared service with our rate company with guaranteed rate affinity, proper rate, certainty, citywide, all of our entire family of rate companies. There's a version for each company. You can go to speak to your loan officer with the company that him or her works for, and they could direct you, but agents.rate.com, and all loan officers with all companies are options on Agent Advantage to partner up. And the Agent Advantage website, again, it's no cost. It's got tons of marketing content and tools. It's got a full-blown CRM. It's got coaching and training at no cost. We do the Tom Ferry events. We do webinars like this. It's got connections to your expert loan officer, of course, and views of your transaction and process. We do have a Facebook page as well. It is Agent Advantage Insider. It's a closed group just for our agent referral partners. Click that QR code and you can request to join. All are welcome. All on your team can be a part of the Facebook page, and there you will see what is coming up with the next Agent Advantage webinar or new. It's also a forum you can share things going on in your community. So again, today we are grateful to have Ryan Ogata, and Ryan is our Executive VP of Reverse Mortgage here at Rate, but he helps originators with all of our companies. And I would like to introduce and bring Ryan on to help me and to help everyone on the call understand the world of reverse mortgages. How you doing, Ryan?
Doing good. How are you today?
I am great. Again, I want to thank you for being here. I will repeat that if anyone has questions for Ryan, put them in the chat in the go-to here, and we'll save a little time, but no one knows more about reverse and HECM products than Ryan. So again, happy to have you here. I'm going to switch over to your presentation, and I'll let you get rolling. But again, thanks, and again, if anyone has questions, let us know.
Well, thank you for that introduction, and thank you everybody for joining us today. We are going to be talking about reverse mortgages and one particular application that is very relevant to the real estate agent community, and that's the reverse for purchase transaction, right? So it's the opportunity to buy a property with a reverse mortgage and enjoy sort of all the benefits that a reverse mortgage provides for the retiree, for the senior buyer. So let's jump into this. The next slide, please. So as the
Here's all the companies that I tried to mention
all
before,
our
but yeah,
companies.
everyone, and this is for one and for all, but there's
Noah
a little
says,
menu of everyone. Yeah.
okay, so let's talk about this. What is this opportunity, right? I'm going to kind of frame this as, are you missing out, right? So if you're a real estate professional and you're not focused on the baby boomer market, right? You're missing out on the largest demographic of people in our history that will need housing services, right? So the baby boomers, big chunk of the US population, and they are sort of at the point where they are going to be looking to, they've already started, but there's a massive business opportunity out there that we're going to kind of dive into. So next slide, please. Okay, the baby boomers, right? I'm going to give you just some information about just how large of a force they are in the market. There's about 76,400,000 boomers, as part of the U.S. population, and they have an 80% home ownership rate, right? Very high. If you shift over here to the right and look at some of these statistics, you'll also know that they are a very large force in the marketplace today. 52% of all sellers in today's market are in fact baby boomers. They are number one of any generation. 39% of all home buyers in today's market are also baby boomers. Again, number one by slice of the pie, the most of any generation. The last statistic here is an interesting one, right? 90% of all boomer buyers use an agent, to facilitate their transaction. Again, the most of any generation. Why I chose to include that statistic is, when you think about all of the external forces that are looking to penetrate into the real estate, space, right? Either on the real estate side, on the agent side, or the lending side, right? You've got all these technology companies that are trying to kind of undercut the value that I think you as the real estate professional provide, us as a lending company provide. This segment, this demographic of customer seems to value the service aspect of what it is that we provide more than any other segment, right? So looking at the baby boomer a little bit more, the top two reasons, right, baby boomers are looking to move today are to be closer to family and friends and to downsize. Right, so when you think about this is your opportunity as a real estate agent to facilitate both a sell side and a buy side transaction for the same customer, right? So if you think about the baby boomer, right? Chances are they are empty nesters. Maybe they have a 3-bedroom, 4-bedroom home that's too big for kind of where they are, today, and they're looking to kind of shrink their footprint a little bit, downsize, maybe move to be closer to their kids, right? There's going to be this sort of mass kind of migration for the boomer, and there's a lot of real estate services that are going to be needed as a result. The last number I want to talk about here is this $200,000 figure, right? That is the median retirement savings account balance for a boomer, right? Now, why is that relevant? Well, $200,000, is it's a significant amount of money, but I think most people are going to agree it's probably not enough to get somebody through a successful retirement journey, right? We're going to talk about the significance of that $200,000 figure later on in the slide. I just want you to remember that that is in fact the median retirement savings account balance for a boomer. Next slide. Okay. If you weren't aware, there is something of an inventory shortage in the U.S. housing market. And why is that? Well, homeowner tenure is in fact increasing, right? The typical U.S. homeowner has now spent close to 12 years in their home, almost double the time from just 2 decades ago, right? And a big part of that is, some mortgage rates are really too good to give up. Right? You think about the environment that we were in 2020, 2021, where refinance volume was at an all-time high. A lot of people locked in interest rates that are very low, relative to what's available today. Some of the loan rates that people locked in the 2% range, even the 3% range, right? You compare that to the high 5, mid 6% range that we're in today, right? It's very difficult for someone to fathom, giving up that low interest rate that they have to buy their next house. Looking at the boomers in particular, right? The boomers are aging in place. 40% of baby boomers have lived in their homes for 20 plus years. Another 16% have lived in their homes for 10 to 19 years, right? So this segment, again, has held on to a big chunk of the US housing inventory, and they're aging in place. At some point, they are going to have to give up that home that is likely too big for where they're at in their life. You know, by contrast, only 35% of Gen Xers, right behind the boomers, have lived in their home for 10 plus years. Now, that statistic really shouldn't come as anything of a surprise when you think about Gen Xers and the millennials. They obviously bought their homes after the boomers, so it makes sense that they've been in them for you know, less time. Shifting over to this graph that was provided to us by Redfin, it really just shows, you know, the sort of different home ownership, you know, numbers by generation. And you've got the boomers who, you know, definitely been in their homes the longest, Gen Xers, millennial, Gen Z, right? Just interesting data to kind of just be cognizant of as we start to think about, you know, how many homes the boomers are sitting on that are going to need to be sold. Next slide, please. So people hanging on to their homes is contributing to this inventory shortage, despite the need to transition. And there's some really good reasons as to why this is happening. First off, older Americans are hanging on to their homes because they are financially incentivized to do so. 54% of boomers who own their homes own them free and clear. For those that do have a mortgage, the outstanding balance is likely smaller, right? They've been in that home for a while, they've paid down that balance, right? And on top of that, the interest rate that they've got is likely much lower than today's, you know, let's call it high 5, 6, 7% range. So from a monthly cash flow standpoint, the boomer is in a really, really good position. Another, you know, sort of phenomenon that's contributing to this inventory shortage is that, you know, older Americans are in fact hesitant to sell and downsize because financing options are more restrictive for retirees. When you think about most mortgage programs, they are qualified based on income, and the retired borrower has less income than they did before. As much as housing values have gone up substantially, and there typically be enough sale proceeds to pay all cash, liquidity concerns contribute to the reluctance to sell and downsize, right? You've got transaction expenses, capital gains. Remember, we talked about this $200,000 figure, right? And, you know, a lot, or I'd say most of the boomers, they are in fact, you know, let's just call it house rich and cash poor. So liquidity is kind of on their mind as to kind of how they're going to be able to sort of get their hands on some of that liquidity, also, you know, maintain their standard of living, home ownership, right, and get through their retirement. So next slide, please. Let's look at a transaction, right? So, you know, how much is really left over after commissions, closing costs, and capital gains? So I just picked, you know, 800,000. Now it might be high for your market, it might be low. You know, when this is a national call, it's very difficult to find an example that's going to be relevant to all markets. But let's just kind of go through this math so you can kind of see what I'm looking at. So selling a home that's worth 800,000, you've got your agent commissions of about 6%. That's going to be $48,000. Transfer tax, right? Now I am from the San Francisco Bay Area. In San Francisco, we have to pay a transfer tax when we sell a property. At this price point, it's going to be $3.40 for every $500 of home value. That's going to be $5,440. You've got some, you know, miscellaneous expenses, JCP reports, and energy efficiency, you know, whatever your municipality has might be another, you know, $1,200. So in this example, the proceeds to the seller are going to be $745,360, right? That is not the entire picture. Okay, so I want to layer in some capital gains just so you can kind of get a sense of what, you know, additional, you know, sort of taxes are going to do to this figure. This property was originally purchased in 1978 for $100,000, right? In this instance, the seller has a gain of $645,360. The capital gains exclusion for a married couple is currently $500,000. If they weren't married and it was a single person, it'd be $250,000, right? But let's just assume they're married. There's going to be an additional $145,000 here, the gain, right? Net of the exclusion that's going to be subject to long-term capital gains. Currently, between state and federal, right? I'm talking about San Francisco for this example. So California is probably one of the highest tax states in the entire country. right, there's going to be another, anywhere from 15 to 33% of taxes due. So I'm just going to assume the 28% bracket, right? This is going to reduce the proceeds by another $40,700, leaving the seller with $704,660, right? So it cost them about $100,000 to exit this property, but that $700,000 is really what's going to be the money that is going to bridge the gap between the savings shortfall, the $200,000 sort of estimate of what the average account balance looks like, and what somebody needs, right? This is that $700,000 right there is what a lot of people are looking at as being the means to get them through retirement. So next slide, please. Enter the reverse mortgage. Okay, I'm going to give you the textbook definition here. A reverse mortgage is a financial product primarily designed for homeowners 62 and older with limited income to convert a portion of their home equity into cash while retaining ownership of the property or to purchase a new property, right? We're here today to talk about this reverse for purchase, but let's just talk about reverses in general before we get into that. The loans do not require any repayment until a maturity event occurs, and that's either selling the property or moving out of the home. There's different types of reverse mortgages, but the most common one that you're going to encounter is the FHA Home Equity Conversion Mortgage, also known as the HECM. Next slide. Some common applications of reverse mortgages. Pay off a forward mortgage and eliminate monthly payments, right? So for the customer, maybe somebody just wants to stay in their home. They've got a mortgage balance outstanding, and maybe they want to increase their monthly cash flows by not having to pay that mortgage anymore. They can refinance into a reverse mortgage, right? And they don't have to make any more payments on that loan. Another application is to set up monthly distributions and create a tax-free income stream. Another very common application, right, is we can actually annuitize the equity in someone's home to give them, monthly income to help better their cash flow situation, right? So in both of these first two instances, we're really talking about cash flow. In the first example, we are doing away with the mortgage payment, right? So let's just say it's, $1,000 a month, maybe $2,000 a month, depending on kind of what that payment is. Not having to pay that, that's the surplus of cash flow that you get. And in the other example, you actually get a monthly distribution, from your home to help pay for your expenses. The third example here is to just establish a line of credit to draw funds as needed, right? When you understand this product, you'll realize that it does work very, very similar to a home equity line of credit. It's better in a lot of ways, but the fundamentals are there, where it is something of a line of credit where you can draw funds out, pay them back, draw funds out, pay them back all day long, except with the reverse, you don't really have to make any monthly payments. A lot of people use this to fund home improvements. Maybe a very common application is adding a accessory unit in the backyard if you've got the land for it, maybe to consolidate some debt obligations, pay for medical expenses. In-home care is a big thing for this age demographic, right? And this is the mechanism that will, allow people to extract equity from their home to pay for all that. And the last one here is to finance a purchase with limited income requirements and no monthly mortgage payments. Next slide.
Yeah, so to speak of that first one, so this is almost like an investment play, but that first option, if the amount of equity in your home is greater than the balance on your mortgage, a refi reverse just eliminates your monthly mortgage payment.
Correct. So you basically, let's just say you own a home for, I don't know, like $500,000, and maybe there's like $150,000 left, right? You're not going anywhere. You could refinance your loan, your outstanding balance to a reverse, and maybe there's even enough in there to give you more funds, right? That $150,000 balance is very small relative to the value of the home. So again, you can do away with your monthly payments and free up your cash flows that way. It's a very common application.
Very good, thanks.
Yeah, let's move on. Next slide, please. Eligibility requirements. Okay, again, very, very different than the forward mortgage, right? When I say forward mortgage, I mean traditional financing, like a 30-year fixed. The borrower requirements, you got to be at least 62 years of age or older, 55 for certain programs. There's no minimum FICO score requirements. Even if your credit, is very, very low, that's not going to be a requirement of the program. You do have to occupy the property as your primary residence, so we can't use this for investment properties or vacation homes. It has to be done in your primary. And the other big one is that you just cannot be delinquent on any federal debt, right? So if you got back taxes, stuff like that, that's fine. You just can't be delinquent on the actual payments. Eligible property types, single family residence and townhomes, right? 2 to 4 unit properties. If you have 2 to 4 unit, multi-unit in your place of business, this is actually a great application for a reverse mortgage because there's no monthly payments. So if someone is fortunate enough to own a multi-unit home, they get the benefit of all the rental income that those additional units generate, but they don't have to pay a mortgage payment, right? So again, it's almost like a double cash flow situation there. HUD approved or FHA approved condominiums, right? If it's not on the FHA approved list, don't worry about it. We can facilitate what's called a spot approval so long as the project qualifies. And then manufactured homes that meet FHA standards. So the typical residential property types that you're used to seeing all do qualify for reverse mortgages. Next slide. Okay, before we go any further, I do want to kind of address the elephant in the room, but it's not safe. Reverse mortgages do have something of a, negative stigma attached to them. The loans, were in fact very predatory, and I would say that stigma is, rightfully earned. It's deserved. Big government has really stepped in to make the program a lot safer than what it used to be. The fact of the matter is, for reverse mortgages today, most of them are in fact regulated by the Department of Housing and Urban Development, HUD. And the US government has been proactively adding industry safeguards to make the program much better and safer for consumers. I'm going to argue that it's probably one of the safest financial products that is available on the market today with all of the government regulation that has in fact been added. So let's talk about some of these bullet points. Next slide, please. Reverse mortgage counseling is the big one. So before submitting a reverse application, borrowers are required to meet with an independent third-party HUD-approved counselor. Reverse counseling is an impartial educational resource to help seniors and their family members make an informed decision about reverse mortgages. The process is mandatory for all transactions. So look, even if the reverse mortgage is in fact the proper sort of tool for what the customer is looking to do, even if a great loan officer sold the product well and identified all of the pros and the cons, right? Assuming a borrower went through kind of that great path about getting information, they are still going to be required to meet with an independent third party that makes sure that they understand what it is that they're ultimately signing up for, right? So it helps to weed out, some of the bad players in the space that are unfortunately still out there, right? This helps to weed them out and make sure that customers fully understand both the benefits and the cons of the program before they actually sign up for it. Some of the actual kind of protections, right? The next one here, non-recourse protection, right? These loans are in fact non-recourse. Even if home values decrease, right? The borrower or their heirs can never be liable for any amount over the value of the home. Look, I remember 2008, right? I got into the business, over 20 years ago. And 2008 was the big kind of year where, the mortgage market imploded on itself and home values, across the entire country, went down. And a lot of people found themselves upside down, right? Well, this loan is 100% non-recourse. Even if, that situation happens again, and someone does in fact owe more than the property is worth, they are not liable for any amount of that debt. We also have non-borrowing spouse protections. So to be eligible for a reverse mortgage, only one borrower must be over the age of 62. Except for the state of Texas, a little bit of fine print, both spouses in Texas do need to be over the age of 62. Eligible non-borrowing spouses can remain in the home without making monthly payments, even if the borrowing spouse moves to assisted living or passes away. So even if one borrower was not in fact age eligible at the time that the loan was put in place, they get to enjoy all of the protections that are afforded to anybody who got a reverse mortgage. And the big one there is that the disruption to their lifestyle isn't going to happen because they do not have to make monthly payments. They can stay in that property, right? It's a great protection that was added not that long ago. Next slide.
Yeah, and there's no minimum age for the spouse then, is there?
There is no minimum age. Now the fine print on that, I'm just going to use an extreme example to illustrate, what I'm talking about. Let's just say one qualifying borrower is 62, and the non-qualifying borrower who's eligible might be like 20 years younger. The calculation that we do in order to determine how much of a reverse mortgage someone is going to have access to is always going to be tiered to the younger of the two. So as much as this is in place as a protection mechanism, it's not sort of a way to kind of circumvent the rules and abuse the program. We're going to be conservative with the calculation based on the fact that there's a high likelihood that the younger spouse is going to live significantly longer than the age eligible applicant.
Yeah, makes sense. And that
makes sense, right? It makes sense when you understand it.
And they can remain in the home even if the borrowing spouse goes to assisted living, as it says in the last point. So
1,000%. Again, these are well thought out. The last thing we really want to do is disrupt somebody's kind of life. So again, a lot of these protections, they make a lot of sense when you understand them, and I think they're great for the consumer. All right, monthly payments are optional. That's a big misconception, right? A lot of people think that once you go into a reverse mortgage, you don't get to make any monthly payments, and your mortgage balance is going to explode on you. Well, that's not true. Actually, monthly payments are in fact allowed, and we encourage people to do them if they can afford to. Right, the borrower can choose to make a payment at any time. We also have adjustment caps. These are variable rate loan products for the most part. And if you're familiar with how variable loan programs work, when interest rates go up, the cost of borrowing, ultimately goes up. Reverse mortgages have this neat little kind of safety clause where there's an actual limit as to how high the interest rate can actually adjust, regardless of what the kind of interest rate environment at large is doing. It's going to be capped to 5% over the start rate. So if you think back to the 80s when we were in kind of just double digit, kind of interest rate environment, right? And let's just say you were kind of fortunate enough to get a reverse mortgage, like now as an example, even if you're returned to 18% interest rates, your loan isn't going to be subject to that high of a cost of borrowing. The safety clause kind of kicks in, and your borrowing kind of costs are going to be capped to 5% over the start rate. Another just great kind of consumer protection piece that's been built in there. And the last one here is just no prepayment penalty, right? The borrower can repay the loan at any time. They can refinance out of it. They can pay it off, and there's no consequence at all for them to do that. So just a lot of great stuff has been added to the program to make it better for consumers. Next slide, let's move on. Okay, let's get into reverse for purchase while we're all kind of here, right? The reverse for purchase was actually introduced in 2008, and it provides buyers the opportunity to purchase a new home and get a reverse mortgage at the same time. The typical application is a buyer looking to downsize. So the benefits: optional monthly mortgage payments, right? So when you think about this downsize, maybe somebody has a home that they own free and clear, and they sort of like not having to make a monthly mortgage payment, right? This program allows them to get financing on that home, but they get to keep the sort of no monthly mortgage payment to help their cash flow situation. So a little kind of extension of that is the next bullet point. There's no repayment due on this loan until the home is ultimately sold. And then the last big benefit here is going to be increased savings from sale proceeds. Right, again, we talked about that $200,000 figure in the beginning being something of a sort of retirement savings shortfall. We went through the example where it's going to cost somebody about $100,000 to sell in the $800,000 example, and they're going to net $700,000, right? They get to save more of that $700,000 by getting a reverse mortgage as opposed to sort of paying all cash for their next transaction. So let's take a look. Next slide. Oh, sorry. What makes it good? Qualifying income and cash flows, right? For borrowers who aren't earning regular income, a reverse for purchase can afford a viable way to finance a new home. The loan amount is a function of down payment and age, not income. These borrowers also find the optionality of making mortgage payments to be advantageous to their financial situation. So again, we're really sort of checking a lot of the boxes for what is important for retirees at this point in their life. Next slide. Okay, this is going to be the most technical slide that we're going to look at today. And I included it because I want sort of everyone on the call to understand, how it is that we ascertain how much somebody is going to be able to borrow. So we're talking about leverage that's going to be based on age and interest rates, not income, right? In the forward mortgage space, the traditional 30-year fix, as an example, you're probably familiar with hearing like this acronym DTI, right? Debt to income ratio. We're always looking at how much somebody wants to borrow is going to be, relative to, or how much they're able to borrow is always going to be relative to how much income they're bringing in. That doesn't apply with a reverse mortgage. So I've got this chart here. We've got LTV on the vertical axis, right? LTV, that is an acronym in the lending space, loan to value, and it represents the percentage of financing on a home, right? If I said, hey, the home is worth $200,000 and they have a 50% loan to value, right? That would mean a $100,000 loan was on that property, right? 50% of $200,000, $100,000. On the horizontal axis, we've got age. And what you're noticing is as a borrower gets older, the amount of LTV that we're going to give to them gets higher, right? So if I say, hey, let's look at somebody in the mid-60s kind of age bracket, they're looking at, anywhere from 34% to 44% of LTV. So on a, $100,000 home, that'd be $34,000. On $1 million home, that'd be $340,000, right? Going up the age spectrum, maybe to like age, 90 as an example, then we're going to open it up a little bit more, right? And 60%, 62%, in some cases. So just remember that the thing to take home here is really the older you are, the more of a loan you're going to get on a reverse mortgage. The other piece that plays into this is the interest rate environment. And I've got a comparison here of 5%, 6%, and 7% interest rates. Right. So what you're noticing is in a lower interest rate environment, the amount that someone is going to be able to borrow is going to be higher than in a higher interest rate environment where it's going to be lower, right? And that makes a lot of sense when you understand these reverse mortgages, right? There's no payment due on a reverse mortgage. So the principal is going to get larger as time goes on. In a higher interest rate environment, that principal is going to grow at a faster rate, and therefore we are going to start the borrower off with a smaller loan amount. Conversely, in a lower interest rate environment, that principal is going to grow at a slower rate, so we're able to start them off at a higher loan, right? So really, again, forget what you know about normal conventional 30-year fixed mortgages and income being part of the equation. That doesn't apply. In reverse, the general trend is going to be the older you are, the larger of a loan you're going to be able to get, on any given property. Next slide. Okay, so let's look at a scenario and see how this applies. All right, so we've got an 85-year-old buyer with cash assets of $700,000 who's looking to purchase a $500,000 home to be closer to family, right? So in that first example, right, our seller netted $700,000. That's what they've got, and they want to buy a $500,000 home. The buyer's retired and has limited income. As a result, normal mortgage financing options are limited. With a traditional mortgage, we can only qualify for about $150,000 in the loan amount. This requires a very large down payment and requires monthly payments, right, on that mortgage, which are going to impact the buyer's cash flows. Retirees have income, Social Security, maybe they've got, distributions from a retirement account, right? There is some money there for us to use for a traditional mortgage, but as we're going to kind of show here, maybe it's not the path that this borrower is going to take. At 85, we can also structure this as a reverse for purchase loan and finance $255,000 or 51% LTV, right? 51% of 500,000. That's where I got the $255,000 figure. This leaves the buyer with more liquid savings, right? Because they're going to put less money down and better cash flow because they have optional monthly mortgage payments. Next slide. Let's kind of look at things side by side and see what I'm talking about. So the first column here is the traditional purchase. This is the one that I think everyone is very familiar with. On a $500,000 property, if you're going to borrow $150,000, you've got to do a down payment of $350,000, right? That $350,000 is going to come out of the borrower's savings, right? Their $700,000 nest egg is reduced by half. So they've got remaining savings of $350,000. They've got a mortgage payment of $896, taxes and insurance, maybe call it another $760. So their total housing expense in this example, $1,656, right? Okay, you know, it's not bad. You know, a big chunk of their savings was applied to the down payment, but the buyer does have, you know, some cash flow concerns. Let's look at the all cash purchase option, right? This one, if you're going to buy a $500,000 home with no loan, your down payment's going to be $500,000. That's going to deplete their savings down to $200,000 net remaining. They've got no mortgage payment. They still have to pay their taxes and insurance. So from a cash flow standpoint, they're actually doing good, right? They don't have a mortgage payment at all, but you know, they got very, very little liquidity left over because most of their savings was depleted, and it's going to leave them vulnerable to any emergencies. The last example here is the reverse for purchase. So because we're borrowing $255,000, right, we only have to put $245,000 down. That's going to leave them with $455,000 liquid. It's the most out of the three options. Moreover, it's a reverse loan. It doesn't require any monthly payments. So all they're on the hook for every month is going to be their taxes and their insurance. So look, from a cash flow standpoint, they accomplished the exact same thing as if paying all cash, but they got the benefit of getting a mortgage, and they were able to borrow more than their income would allow them to if they had done a traditional 30-year fix and get this reverse mortgage. I'm going to make the argument that this is the best option for this customer to consider because they get to keep the most liquidity and it lowers their overall housing expense. This is why it's such a powerful tool for the downsize for the retiree. Next slide. Let's look at another scenario, right, to just kind of think about this a different way. So here we've got a 70-year-old retired couple selling a home and looking to downsize. After capital gains, their loan payoff and transaction expenses, they only get $450,000 in sale proceeds, right? They found a new property for $600,000, but they don't want to take any additional funds from their savings to complete the transaction, right? Maybe they met with their financial advisor and their advisor said, look, you've got enough in your retirement portfolio from a cash flow standpoint to get you through retirement. I don't want you to touch those funds, right? So, you know, they don't want to add any additional debt. They don't want to impact their cash flows, right? This is where this reverse mortgage comes in. At age 70, on the lower end of the spectrum, oh, let's go back one slide. So we went back to the beginning here.
That's the correct one?
Yeah, two more forward, please. Here we go. At age 70, they can borrow $222,000, 37 LTV, right? They're younger, so they're going to borrow less in percentage of LTV with the reverse mortgage and have optional monthly payments. So next slide, let's look at this one on a chart just to look at it really quick. Okay, so all cash. Well, I don't think it takes a PhD in mathematics to realize that if they've got $450,000 to contribute and they want to buy 600, they're going to be short $150,000. That's not going to work, right? But the reverse mortgage, they're able to borrow $222,000, so their down payment's going to be $378. They do have some closing costs, right? We didn't put closing costs in the last example just because I wanted to kind of look at things just kind of structurally to get us thinking about reverse. But they do have about $19,000 in closing costs for the reverse, but they've actually got a little bit of a surplus, funds remaining of $53,000. They didn't have to contribute the entire $450 to close this deal. So they were able to effectively extend their cash purchasing power. Next slide here, we're getting to the end. Let's talk about closing costs really quick because I did introduce them. The closing costs for reverse are in fact a little bit higher. We do have this upfront mortgage insurance premium. That is what makes the loan non-recourse, and it's going to be 2% of the property value for most transactions. There's also an origination fee, which is going to range, depending on the property value, of anywhere from $2,500 to $6,000 for most transactions. And then the traditional third-party expenses apply, like appraisal, title, all that stuff. The good news is that interested parties may contribute up to 6% of the purchase price. So you can structure a seller credit to the buyer to help cover some of this, right? We're limited to 6% there. That is in fact a new development in the reverse for purchase kind of space that was added at the beginning of the year. Next slide. Really quick highlights just to kind of think about reverse versus conventional financing. In reverse, you've got an age restriction. It's 62 for most programs. For conventional, there's no age restriction. Monthly payments are going to be optional for reverse. They're required on a forward mortgage. There's no DTI and there's no FICO score requirements for reverse. You do have debt to income ratio and you do have credit score requirements for traditional financing. For reverse, typically the loan balance is going to increase. Remember, you're not making monthly payments, right? But in a forward mortgage, maybe it's a fully amortizing loan, that balance is going to go down as time goes on. In both instances, you do have to pay your property taxes, your insurance, and you do have to maintain the home, right? Reverse is non-recourse, right? In the forward space, you do have the risk of foreclosure if your payments aren't made. So when you think about, again, an elderly, a senior buyer taking on a 30-year fixed mortgage in their 80s, right? Maybe they do encounter some cash flow, sort of issues, later on in life. They're still stuck in that 30-year mortgage and they have to continue to make those payments. And in both instances, the borrower owns the home, right? Again, this is really kind of just to kind of crush the negative, opinion that a lot of people have about reverse mortgages, where you're kind of giving away the keys to your home, the bank is stealing it. It's like any other mortgage. If you have a reverse mortgage, you own the property. There's no funny business going on anymore. And I think that's all we got, Kurt. I'm hoping there's a couple questions, from the group. Hopefully everyone found this informative. Thanks for sticking around. But if there's questions, maybe let's talk about them.
Yeah, I do have questions. First, I want to say I promised one viewer I'd go back to the graph.
Cool. Let's go back.
I just want to show you that. But I want to say, Jessica, Laura, Tom, Frank, will have this whole presentation will be recorded. It'll be archived on the site. We'll send it to everyone that registers. So don't worry. We will. If you're on this call, you will be sent a recording. Let me give you some questions, Ryan.
Please.
Are escrow holdbacks permitted? Question from Matt.
Escrow holdbacks. Okay, that's you brought up a really, really good one. We can do a set aside if it is a refinance transaction. Maybe you got some work that you need to kind of complete. If it is a purchase transaction, holdbacks are not going to be allowed. The seller is responsible for bringing that property up to minimum FHA standards that's going to be determined by the appraiser before we're going to be able to close on that transaction. That's a very, very good question. We do need to have, all the items that are brought up in the appraisal addressed, fixed, cured before we can close on the deal. Good question.
Lots of great comments. Thank you. Great information. Thank you. Can they qualify if they've had a bankruptcy from Jose?
I'm not going to answer that one as a blanket yes or a blanket no. Every single transaction is going to have specifics, often, kind of just a little bit of hair attached to it. It's not an immediate disqualifier is how I'm going to do that. Now, the entire sales force, of the family of rate companies is familiar with these reverse mortgages. If you do have, a specific, scenario that you do want to kind of get sort of, additional kind of eyes on before we kind of go down the road of making offers, stuff like that, I do encourage you to reach out to your representative, be it whatever company they're at, to get more information on these, and we can talk about the individual scenarios. I don't like to give blanket answers on something like that. The answer is kind of yes and no, depending.
I thought that may be the answer. Here, this one might be specific as well. If a borrower does not have enough equity, let's say they are $50,000 short, can they finance that 50,000?
Good question. They cannot. So again, they're not going to be able to get additional financing behind a reverse mortgage. And when you think about it, it makes a lot of sense. Reverse mortgages are designed to get larger as time goes on. Finding additional financing to go behind a reverse mortgage is going to be next to impossible because the investor who's doing that knows that the balance in front of them is getting larger. So they're not going to put themselves in that scenario. So it's really a first mortgage, that is the reverse mortgage, is all that we're going to be able to do on these transactions.
And this next question, I'm sure this is common. What happens if the owner passes away? What about my heirs? Have I given my equity away? This would be an option to, leaving the home to someone.
That's a really good question. So actually, Kurt, let's go back to that chart really quick that was brought up, because I want to highlight this. Reverse mortgages, they are, look, it does, your equity in the home goes down as time goes on, right? But if you take a look at this chart here, right, I'm going to use the extreme example of a borrower who's 99 years old, right? The reverse mortgage is still only going to give them, let's just call it a 70% to the maximum 70%, financing on that home, right? So the calculations behind this are very conservative. The likelihood of a home being, transferred post-death with no equity in it at all is very, very low. Now, I'm not going to say never say never. There could be an anomaly in the market where real estate values, plunge across the entire country, right? But, for the most part, if you look at this chart, you're going to see that there's equity even at being, close to 100 years of age. So there's going to be money to pass on to the heirs.
Thank you for that. Yeah. People living longer, and I think as you put it at the beginning, people are aging in place because they are, at a low rate or comfortable where they are, or can't find that ranch home that they're looking for. I think this would make a lot of sense to a lot of people. Let me do one quick check.
Any other questions
we got? This one. What about interest rates on this loan?
Yeah, they're variable rate, right? So, right now we're kind of in the, let's just call it the 6%, sort of range. It is a CMT product, if you're familiar with that index, and then we add a margin to it. The margin, depending on what the borrower is looking to accomplish, is typically going to range between the, let's just call it 2% to 2.5%. And there's reasons, that are just going to be specific to a transaction as to why it might be higher or lower.
Here's one more. Sorry, Ryan. I have a 96-year-old aunt, and she's living in the property with her sister and a healthcare worker. Does she have to go through that class, that one step you talked about? And can she be helped through that? They're trying to keep the older aunt in the home.
Yeah. So again, that counseling session is mandatory. It is going to be required, and it's a consumer protection piece. If you have a scenario like that, I'm going to encourage you to reach out to your loan officer that you're working with, at our company. If you want to flag it and say, hey, I was on Ryan's presentation, let's chat about this one. I can kind of inject myself a little bit, and we can see what we can do for your aunt. But we would love to help her out.
And what about additional fees? I think your one slide covered the fees associated with the product.
Yeah, so those are, again, think a normal transaction, right? An appraisal, escrow, all the normal transaction fees. We just add, 2 of them, right? It's going to be 2% of the property value for the buy-in to the insurance, and then it's going to be anywhere from $2,500 to $6,000 as a flat fee, depending on the value of the property. Those are the reverse specific fees. Everything else is kind of standard, what you're used to seeing on a normal transaction, appraisal, title, all that good stuff.
Very
Oh, you
good.
can? Yeah.
Yeah, I think, thanks for hanging out. And I love it because, a product that, like you said, had so many negative connotations, after listening to your presentation and how you simplify everything, it just becomes such a beneficial and positive and exciting
It's
thing
a
for
great product
buyers and
today.
family. Yeah,
It's a great product for anybody who's age eligible. I mean, again, you think about just sort of how much equity, people are sitting on. If they were fortunate enough to buy a home, and they've been sitting on it for 30, 40 years, right? Chances are it's the biggest part of their balance sheet. And this is a product that really just sort of changes people's lives and gives them kind of just a better quality of life in retirement, right? They've worked hard for that equity. Right? They should be looking, for ways to use it, to use it without disrupting their lifestyle. So,
yeah,
thank
like
you
I said,
everybody for joining us, today. If you have any questions, please reach out to your representative. The whole sales force is familiar with these products at this point. We'd love to help you out.
yeah, like I said, it's really an investment play. One more quick one. What happens if
Yeah.
if their homeowner's insurance is canceled, the insurance piece?
They've got to find insurance through another provider. Some people are facing that. I'm in California. We've got an exodus of insurance companies that are happening, but that's going on right now. But there are insurance providers out there. They're just going to have to kind of shop and find another one.
Would think so. Okay, very good. So Brian, thanks for sharing this and letting people tap into all the equity they have in their home. But really appreciate your time, and thank you everyone for joining our webinar. Please join us for a future Agent Advantage webinar. If you need to get a hold of us, agents@rate.com. Let us know what you thought. Let us know if you have any other topics for any future events. Ryan Ogata, thank you so much. Everyone,
Thank
have a
you for
great
having
rest
me.
of your day. Appreciate it.
Thank you, everybody. Take care.
Well done. Have a great day, everyone.